This week we will be covering Chapter 5, which is on national income accounting. Now, there's several methods for keeping track of a nation's output and income, but we're going to focus on just a few. Now, national income accounting is just basically a method for a country to measure their output and income. In the last chapter, we were able to look at our circular flow diagram where we saw that there is always income flowing into the households from the businesses. There is always expenditures flowing from the household into the businesses. And so we basically need a method to keep track of all that. What is the total value of output being produced in relation to the total value of income that it's generating? And it should equal, each other. Now, national income accounting will measure the output of the entire economy. It's going to be able to track the flow between the different sectors within the economy. So again, thinking back to the circular flow diagram that we covered in Chapter 4, we were able to see how all of the resources and output and income was flowing between the households and the government and the businesses. And then usually when we are using one of our methods for national income accounting, we are reporting the data in a specific period of time, and that usually is a year. So we'd want to look at what was the output of the United States in 2013. But the data can also be broken up and reported, quarterly, monthly, what have you. But usually when we're using our national income accounting techniques, we're looking at the output and income for a year. Now, it is important to know that national income accounting does just estimate the activity or economic activity that occurs during that time period. In other words, it is beyond the capability of the government to count every single transaction that takes place in our modern economy. However, it is useful for us to keep track of this. And of course, countries like the United States, we do have comprehensive accounting systems that give us fairly accurate numbers. Now, the most common national income accounting technique that is used is what we call gross domestic product. So that is the method that we are going to explicitly cover in this chapter. Gross domestic product, most often referred to as GDP, is defined as the market value of all final goods and services produced in a year within a nation's border. So again, it seems like a very simple definition. However, we need to actually break down every component of that definition to understand exactly what is included in GDP. Now, of course, the reason why we're measuring it in dollar values rather than units of goods is because all units of goods produced by different countries have different values. So it's one thing to say I produced 1,000,000 units, but what if those units were oranges and then another country produced 1,000,000 units, but those units were computers? Obviously, computers and oranges have very different market values. So we're always looking at just the dollar value of output that is being produced, not the actual number of goods and services that are being produced when we are referring to our national income accounting technique. Now, what I want to do is break up the definition of gross domestic product into its three main components. In other words, we want to define what do we mean when we say the market value of a good or service. Secondly, we want to know, well, what are we referring to when we say the final goods and services? And then lastly, we want to understand why we are defining it within a specified period of time. And then, of course, the last component would just be that it's goods and services that are produced within the nation's border. And so that would mean that even firms that are not U.S. owned, their goods and services would be included in U.S. GDP if that firm was within the borders of the United States. But we're going to cover the other three explicitly. So the first part of the definition We said it was the market value of final goods and services. In order for a good or service to have a market value, generally it has to meet two conditions. The prices have to be known and the transactions have to be observable. So when you think about, well, what type of transactions take place that are not observable with observable prices, probably one of the first things that comes to mind would be like an illegal transaction. So suppose somebody is selling drugs. Obviously, that is not an observable transaction where the prices are publicly known, so we know that would not be included in GDP. So the underground economy, all of those transactions that take place are never going to be included in GDP because the government is not tracking them. One thing I always tell students, if you're trying to think of whether a transaction would be included in GDP, in other words, does it have a market value, is that a transaction that's taking place in the market that is, being taxed by the government? That makes it very easy to determine whether or not that particular transaction would be included in GDP. But again, it could also just include, let's say that you're bartering. Let's say you have a neighbor and your neighbor produces a particular good and you produce a particular good, and rather than selling those goods, you guys just decide to trade with each other. Well, obviously, even though you guys actually had production taking place, the value of that production would not be included in GDP because it wasn't a observable transaction. You were just bartering with each other and trading the goods for goods. Even if you had a cash transaction, if it wasn't an observable transaction, so let's say you were just selling something on the side and not reporting that income generated from the production of that good, that would not be included in GDP. So again, just to sum this up, we want to remember that we are not going to include any illegal transactions, any bartering, and any cash transactions that are not observable, meaning they're not in the market. So again, let's say I was just growing vegetables in my backyard and selling them to my neighbors. That would not be included in GDP if I was just pocketing that money and not reporting it as income to the government. Now, there are a few exceptions of where the government estimates activity to include in GDP. So a couple of those exceptions would be something like in-kind wages. An in-kind wage is where you're not actually getting a wage, you're getting something else instead of the wage. So suppose you were getting room and board. In other words, you went and you were staying with somebody in return for the work you did for them. Rather than them giving you a paycheck, they gave you room and board. Well, the government will estimate what the value of that in-kind wage would be and then include that in GDP. So that would be an exception of something that that doesn't necessarily meet those criteria of where the prices are known and the transactions are observable. However, the government does estimate the value of that activity. Another thing would be something like home consumption by a farmer. And I use that example because that may be something that occurs here in Kern County. In other words, let's say that you have land and you're a farmer, and that's how you make a living. But at the same time, your family consumes some of the crop that you produce. Again, we would want to estimate the value of the home consumption that was taking place, and then that would also be included in GDP. So those are just two exceptions that are made that don't meet the criteria, but however they are actually included in GDP. Now, the second part of the definition of GDP referred to final goods and services. We didn't say all goods and services. We said GDP includes the market value of final goods and services. And so by definition, final goods and services are just the goods and services that are ultimately available to the consumer to purchase. If it is a good that is produced by a firm, but it is actually used as an input in the production process, we refer to those as intermediate goods, and GDP does not count these. So let me give you an example to clarify. Let's say that I'm talking about a good like tires. Okay, now tires at a tire store where I go and I purchase a new set of tires for my car, that is included in GDP because those tires were produced and sold as a final good to the consumer. In other words, I went and purchased those tires to put on my car. However, let's say that I buy a new car that has tires on it. Those tires are not included in GDP because technically the value of those tires is going to be included in the sale of that car. In other words, those tires were used as an input. The car company purchased those tires from the tire producer and then used them as an input, installed them on the new car that was then sold as the final good or service in the market. So the car would be the item that was included in GDP because that was the final good that was actually sold to the consumer. All the inputs that are on the car, that's not in, their individual values are not included in GDP because those were again what we call an intermediate good. Intermediate goods are the goods that firms use in the production process, and so those are not included in GDP. It is only the goods that are actually sold to the consumers. So we'll look at an example so that we can see how if you included the value of intermediate goods, it would actually make it look like we're producing a lot more than we actually are. So here I have a little graph that is showing the production process that would take place hypothetically for a shirt that you would purchase at a retail store. And so we see that the first stage of production is over here, just, when you have a cotton farmer that grows cotton. So in other words, you have a cotton farmer that is growing cotton and he turns around and he sells that cotton to the textile mill for $1. So we have $1 so far, and then we see that the textile mill takes that cotton and weaves it into cloth. And so they weaved it into cloth now, and now they turn around and they sell that cloth to the shirt manufacturer for a total of $5. In other words, the $4 that they added of value plus the dollar of the value that came from the cotton farmer. So the total sell price to the shirt manufacturer was now $5. So we've gone through that stage of production. The third stage of production now is going to be that shirt manufacturer taking that cloth and weaving it and sewing it into an actual shirt. So that's what they do, and they turn around and then they sell that product for a price of $12 to the retail store. In other words, you see that initially you had the dollar value from the cotton farmer, the $4 from the textile mill, and then they added another $7 of value, which means they sold it to the retail store for a total of $12. And then we can look and see how much the retail store actually sold that shirt for to the consumer. So again, notice here when we're looking at the final stage where it's gotten to the retail store and sold to the consumer, the retail store added another $8 of value. So that means that they sold it for a price of $20. So if we add all of this up, $1 plus $5 from plus $12 plus $20, meaning the value of each transaction that was taking place in the production of this shirt, we would come up with $38. But did we actually produce a good that was worth $38? Absolutely not. We produced a shirt that was worth $20 because that's how much it sold for to the consumer. So if we include the value added at each stage of production, the sale of the good at each stage of production, we would make it look like we're producing way more than we actually are. In other words, we didn't produce a shirt that was worth $38. We only produced a shirt that was worth $20. So you can see why we do not include the intermediate goods. We don't include the cotton, we don't include the cloth, we don't include the wholesale shirt, we only include the final value of the good once it is sold to the consumer, which again was $20. Now again, what we do refer to when we're looking at the process of production is the value added at each stage of production. In other words, these are the intermediate goods, the cotton, the cloth, and the wholesale shirt, and each one of those intermediate goods adds value to the actual good. So in other words, if I asked you, how much value added did the shirt manufacturer add, you would just look to see, well, when he bought it from the textile mill, he paid $5, but when he sold it to the retail store, he sold it for $12. Therefore, the value he added was $7. You could do the same thing if I said, what is the value added by the textile mill? In other words, we see that the textile mill bought cotton for $1 and then sold the cloth for $5. Thus, you just take the difference. Thus, $5 minus $1 means that the textile mill added $4 of value to that good in the production process. So again, just to recap, when we are including the value of a good into GDP, we only want the final value. We don't want the value of what the good is sold for in the production process in terms of the intermediate goods. So generally what we refer to as economists would be two different methods. In other words, you have the final goods and services method, and that would be where you just look and see how much did the shirt actually sell for when it was sold to the consumer. So again, we can clearly see that the shirt sold for $20. So that would just be the price the consumer paid. Or you can use what's called the value added approach. In other words, that you just take what is the value that was added to the good at each stage of production. So we can see that the cotton farmer added $1 of value, the textile mill added $4 of value, the wholesale shirt manufacturer added $7 of value, and then the retail store added $8 of value. And so if we add 1 plus 4 plus 7 plus 8, we still come up with $20. So it doesn't matter whether you use the value added approach or whether you use the final goods and services method. Both of them will give you the same number, which is the value that is going to be, the contribution towards the gross domestic product. So again, you can either use the final goods and services method or you can use the value added approach. Now, the last component of the definition of GDP was when we were specifying the period of time. So we know it says produced in a year. So it does measure the value of the output that is produced within that year. It is the year of production, not the year of sale, that determines the allocation of the GDP. In other words, if you don't keep track, then you could possibly be double counting, making it look like you're producing more than you actually are. In other words, think of something like a car dealership. Let's say I produced a car in 2012 and it was included in 2012's GDP. However, let's say it didn't sell in 2012, it was still sitting on the lot in 2013, and then it was sold in 2013, and we included it in GDP in 2013 also. It would make it look like we produced two cars when in reality we only produced one. So in other words, that's why when we're talking about keeping track of production of goods and including them in GDP, we always include the good just in the year that it was produced, not the year of the sale, to avoid that double counting. And the way that economists are able to keep track of this, or businesses are able to keep track of this, is through keeping records of their inventory. So the inventory is the stock of the unsold goods held by a firm. And so when you keep track of inventory, that allows you to ensure that only goods and services that were produced in that year are included in GDP, and goods and services that did not sell are not going to be included again the following year by keeping those accurate inventory records. Now, going back to my example of the automobile, again, so let's say you had a car that was produced in 2012, but it didn't sell until 2013. So we know that the actual value of the car was included in 2012 because that's the year it was produced. When it was sold in 2013, even though the value of the car was not included in GDP, anything additional that was sold with that car, that would be included in GDP. So any commissions made by the car salesman, so on top, that would be included in GDP. Let's say you purchased a warranty package, that would be included in the GDP for 2013. So again, anything additional in addition to the value of that car, that would be included, but just the value of the car itself would have been in 2012. And also, before I cover what's excluded from GDP, remember that it's final goods and services that are produced within the country's borders. So again, any goods and services produced by U.S. firms that are located outside of the U.S., that's not included in GDP. And then goods and services that are produced within the U.S. borders that are not U.S. owned, that is included in GDP. So we're just looking at the total output of goods and services that are produced within our borders, regardless of whether it's a U.S. owned business or not. Now, these are some of the items that are not included in GDP, so like something like a purely financial transaction. Remember, gross domestic product is just talking about goods and services. Money is not a good or service. So if you go buy a savings bond or you put money into stock, that is not you purchasing a good or service or a firm producing a good or service. That's just moving money. So that is not included in gross domestic product. Government and private transfer payments are not excluded in GDP or included in GDP. So for example, if I send my daughter who's in college $1,000 every month, that's just a transfer payment. She doesn't then count that as her income and have that included in GDP. That was already counted as income when I earned it. So in other words, that $1,000 was accounted for when I received it as income. All I'm doing is transferring it to her. So that would not be included in GDP. Any transfer of secondhand goods would not be included in GDP. So again, think of something like a used, good on eBay or at a garage sale. Those goods would not be included in GDP because of the fact that they were already included in GDP in the year they were produced. So for example, let's say that I bought a computer in 2013 and that computer was produced in 2013. Well, that was included in the GDP for that year. If I turn around and then sell that computer, at a garage sale this year, that's not going to be included in GDP because then it makes it look like we produced another good when we didn't. All I did was sell the good to somebody else. So we don't include the transfer of secondhand goods. And then household services rendered by homemakers are not included in GDP. And so if you take like a gender studies course, that's something that you can look at where they do estimate the value of output that is produced within the home. But in terms of actual gross domestic product, it is not included. So if you hire a housekeeper and pay them to clean your house, that is included in GDP. But if you just clean your house yourself, even though you're doing the same exact thing, providing the same exact service, because you're not getting paid to do it, that would not be included in gross domestic product. And then, of course, I've already indicated that any underground or illegal activities are not going to be included in the estimation of GDP.